Hey guys, Freaky Finance here. 2 weeks ago, we talked about CRISPR. Last week I was doing a lot of yard work, and with earnings coming out, I figured I'm going to do a video more on earnings and kind of updates because I got about 50 positions, so a lot of my time is being spent tracking them during earnings season. So I'm just going to do 9 this week real quick and try to get this within 20 to 30 minutes. Alright, so let's start with Freeport. So most people know, if you remember the video I did, it was more like a reflation play, and that's played out as we thought it would, as the mainstream media started picking up on reflation and inflation. It's kind of what we thought. Copper's actually gone higher than what I thought it would. That doesn't mean much. I'm surprised actually that the share price is still only in the low 40s at copper at 450. If you remember Freeport commodity price play, and then you had the Indonesia Grasberg play, and we can see that they're still executing on their plans. They were only at 75% of their ramp up for production in this latest quarter. They actually released earnings, I want to say 10 days ago, maybe 2 weeks ago. But I thought I'd bring it up here because it's at an interesting point now, right? Because the chart looks almost very, very steep, right? But you got to remember the commodity prices are also very steep, and their production's coming on at the same time. So their free cash flow is very high. And what very high means, well, here you can see EBITDA. And this far outpaces what I thought they'd be able to do. But that's mainly because the commodity price has continued to accelerate. So right now at 1450, you take the middle of this, just say 14.8 or something like that billion in annual EBITDA. So when you look at the market cap of say 60 billion, then their debt's going down to zero basically pretty quick here. It's not too bad, right? 5 times EBITDA. But that's because of the commodity price leverage, right? And they're ramping up their Grasberg production because they already invested in the capex ahead of time. And that's what we knew when we bought in. So far this investment thesis has played out well, though we don't control the copper prices or anything like that. I have some sensitivities here to their free cash flow for 2022 and 2023. And you can see every 10-cent move is $435 million. So commodity prices are a big deal to this thing. Freeport's executing well. On the call, there was no real changes. Basically, there's just my notes that I do for every quarter. I'll go through and just see what's changed and what's not for all the positions that I own. Just really quick and dirty, right? So yeah, I still own my Freeport. I haven't sold any of it yet. I only own 280 shares of it, but still. Grasberg, that's what I want to highlight. You can see that production's double what it was a year ago. And that's what we knew going in. We didn't know the commodity price was going to do like this, but right now copper is still higher than their average price realized in Q1. So we're going to see even better. Well, we should see better results in Q2 based on where we're at right now during Q2 commodity price. And we know production is going to continue to ramp up at Grasberg. So, and we see that not only in copper, but we see that in gold, which is the byproduct that lowers the cost per pound. So very exciting times at Freeport. Really excited for cash flow this year. Fingers crossed that nothing happens in the Indonesia mine. And the free cash flow next year. And then when CapEx actually peels back, it'll be interesting to see what they do. It sounds like on the call, the only thing, when I first bought into this company, say 9 months ago or whatever it was, 6 months ago, they were talking about harvest mode, right? And now they've kind of peeled it back into kind of like a harvest mode and kind of into CapEx mode for Lone Star. And they brought that up back then as well. But now it's coming more to the forefront. So I think that's what they're going to start doing with their extra cash flow, is start investing more into other mines. The original thesis was that they're just going to enter a big harvest mode from 2022 to 2023, 2024, really. But we're going to see some CapEx come back in. But the free cash flow is so high that it really doesn't matter. But it just means less of a harvest, which is fine. It's just a different narrative. And we'll see. Well, like if commodity prices crash, they're probably not going to do some of the CapEx. And we see that with most commodity industries, that they increase CapEx spending as the commodity increases. And so some people might think they missed the move in copper. And it did pass $40 a share. But if copper can hold these inflated prices, they're basically going to probably do some extra, whether it's share buybacks or a special dividend based on the performance of cash flow for the year. We'll see what they do. It'll be an exciting time to be a shareholder of Freeport. Exciting for the management as well, I imagine. And yeah, this is just a debt snapshot for Freeport. So I'm going pretty quick here because I got 9 to go through. So net debt, you can see it continue to trend down very sharply. That's what you'd expect with free cash flow. That's what they're planning to do. They're already near their $5 billion target in debt that they were talking about 9 months ago, 6 months ago. But now it's getting there already, and they might go a little bit lower than that. Though most companies always keep some debt on the balance sheet. Suncor, so that was also this week. So Suncor really function at higher commodity prices like we thought. So quarter over quarter looks good. And you got to remember the Q2 quarter for 2020 last year for Suncor was horrible as well. And Q1 was bad because they had impairments, because that's when oil prices started declining quite a bit. In Q2, they actually had the really low oil commodity price environment for the whole quarter, not just the last bit of it. So They're going to have easy comps in Q2. We're still holding Suncor. You can see one of the things that I like is even though production's actually pretty much back up to where it was, you can see SGA is still lower and the commodity price is higher. So they're cutting costs. Well, commodity price continues to reflate like we thought it would. You can see the cash flow. That, like I always look at, this is the net income, but the most important thing for Suncor is the cash flow. And you can see right here that they did another $1 billion more in cash flow in the quarter relative to a year ago. But yeah, this always stands out, right? When you see the impairment go from the impairment and depreciation go from 4.1 billion to 1.4 in a quarter, right? But that was because they had to take so many impairments like so many oil companies did in Q1 and Q2 last year, which is always fun, but from cash purposes doesn't matter. But CapEx is still light. I'm gonna keep my eye on production just to see if production starts going down, because they actually still are guiding pretty strong, like really strong production, like 2019 levels. And I actually like that. I'm hoping that a lot of oil and gas companies keep their CapEx low, because that further supports the price over time, right? They did pay down $1 billion in debt in the quarter. Total debt is still higher than it was going into COVID, so they're going to continue to do that. I did find it funny that they did a raise, a pretty decent raise, 30-year notes, so 2051. It says something about the industry, because a lot of people view the terminal, even I view the terminal value of an oil company like no more than 20 years, right? So I'm surprised banks are still lending. I don't even know who's lending here, but I'm surprised people were lending to the company for 30 years, but it tells you, and it's at a pretty low interest rate, right? But Suncor's balance sheet's one of the best in the industry. And you can see the commodity price reflate. They only averaged a WTI of 57.8 in the quarter, and right now we're still over 60. So it means more things to come, all else equal, if assuming WTI still can hold over 60. And we never know what OPEC's going to do, so that's always the biggest risk, because it's kind of a controlled price environment on the upside. OPEC still looks good. It's actually light. Production's on track. We mentioned that. And down here you can see the sensitivity to Brent crude and New York Harbor. So something to keep in your back of your head. They did mention on the call that if energy costs rise from inflation, it does hurt, but further inflation should also inflate their commodity price. But most companies that are commodity driven know that their input costs usually rise with inflation, but so does their output price, aka it flows through. Comstock, that was a disappointing one. Let me just finish. I think I did most of what I need to for Suncor. But yeah, Suncor, finishing thought on that before I jump into Comstock is WTI is over 60, which means we're pretty much back to these levels for performance-wise, 2019 levels, but the share price is still below 30, which is pretty funny. And that's kind of a good thing. Well, obviously I'm still long it, but you can see if the share price stays down, they're just gonna, because they are generating so much cash flow, they're just gonna continue to divvy up the cash flow between debt payback and share buybacks based on their current total debt capitalization. So that's what they're planning to do with the cash anyways, pay down debt, and the more debt they have, the more likely they're going to pay it down, and then the less debt they have, the more likely they're going to keep increasing share buybacks. That's what this chart is showing, is how they're returning capital to shareholders. Comstock, if you guys remember that video, that was a winter gas play for a storm in Texas. Mainly, they have a really good expenses, except for their interest expense, because they're a highly indebted company. And so I was hoping during the storm that I would get a little bit of pop. I actually bought here after the news, and I knew that they needed some money. And then I bought a little bit more down here. I sold it during the conference call this week. I still own, I did usually right before the date, if I think there's an event that I have an edge in, I'm going to buy a call option. So that's what I did here. I still own this one. It expires in 13 days from now. Today is May 8th. So this expires in 13 days, but I mean, if you're still in this, technically it's still good in terms of cost, still bad on interest. That's slowly changing over time. I was hoping a little bit more in revenue and bottom line, and then you can see, so the company saves themselves $45 million in annual interest based on their refinancing, but you can see the bank still got $240 million up front, which is 6 years worth of their annual realized savings. So I don't know. It's just for me, there's probably better uses for my capital. So I'm out for now. But if it goes cheap again, like it's still cheap, right? But it's cheap because it's heavily indebted. So if nat gas rises, obviously this is leverage to it, literally. But yeah, I'm pretty much out of that, except for that last remaining call option. First Capital, this is a fun one. So I don't know guys if you remember that video, but really it's like an urban REIT play. During the time of the video, most people were still saying urban's dead, everyone's leaving the cities. Right, and REITs were still pretty cheap. Everyone was like, yeah, office REITs are dead, retail REITs are dead, residential REITs, well, I never technically said that one, but you get the idea. There's no love in the space. And First Capital had a pretty strong retail tenant mix, and then at the time they also had SERS instead of SECRA, right? So SERS helped the tenant a bit more, in my mind, and it also helped the landlord a lot more. It just helped facilitate everything by the tenant themselves applying for CERS, and then they would get the money from the government and give it directly to the landlord, instead of the landlord having to apply on behalf of the tenant. And also, when there was a forced shutdown, the government would actually pay the tenant 90% of the rent, who didn't give it to the landlord. So it actually helped collections, and it helped everything, really. That was part of the reason for buying it at that time as well, was that CERS to SECRA change, or SECRA to CERS change, rather. Slowly been trading up. So you remember I did the video somewhere around here in the 13 or 14 range. Right now it's at 17.50. It keeps hitting 1800 and bouncing down, or sorry, $18 and bouncing down. I still think this should be over 20 bucks. When I go through, the reason why is when I go through the right here, you can see the cash flow by operations actually went up. So they're actually better than they were a year ago, despite COVID, despite the shutdowns. And we also knew that the rent was going to continue to increase. If the average lease term, just imagine the average lease term right now is still 4.6 years, right? So every 4.6 years, there's probably a reset, or there's an accelerator, or there's some type of inflation head. There's some kind of rider anyway that goes up with the market. And we can see that here. To show you, let's just go right to the tab. So first capital, the NAV discount still has a discount. So currently the net asset value of all their properties is $22.48 a share. It's still under 18, so I'm still holding it. Here's the rent showing that it went up slightly, right? 40 cents a square foot. Not bad. And that's despite COVID, right? Everyone's, oh yeah, rents are going to be cheap. Nope. Because you got to remember what they're comparing them against, right? Anyway, occupancy did drop, so that's something to keep in the back of my head. That was the only thing that I saw that was really negative for cash flow ratio. So in the FFO payout, they slashed their dividend almost right after I did the video. That kind of sucked. From my point of view, I was like, oh, but I mean, what they're doing with the cash flow is just developing more of the properties, which is fine. But right now, given the cost of building anything, I can't imagine that they're going to have to revisit that, maybe, or at least I would, just to make sure they're not spending too much for a development play. So I'm going to watch that as well. But yeah, I still own it. Yeah, it briefly hit 18 on Friday. It doesn't pay a very good dividend yield for a REIT. That's because they're trying to redevelop their property. And when I went to, let me just show you this, kind of jumping around here. Here you can see they have 8.4 billion in same property, and it generates decent amount of operating income, right? 98 million, 3 months. But you can see they have 1.1 billion worth in assets that barely generate any income. And so obviously that doesn't show up on the P&L. So what's going to happen, and one of the reasons for the discount, is that a lot of their property is still developing, right? And some of it's held for sale. Right here, you see 250 million held for sale. And they have land development, so properties under construction, ground up development. So a lot of development costs currently going on. So that might be one reason why it's still trading at a discount. It's also one of the reasons why I like it over time. Though again, it does have a lot of torque to the GTA area, which could always be a risk. But right now, like I said, the NAV is 22.5. Lumen, I haven't really talked about this yet. Just think of it like CenturyLink and like legacy cable. And then you also have a fiber business, and you have voice, legacy voice. So you have like a declining business, but then you also have, this is fiber business. Most people have written this company off, like most cable companies, as slowly getting the cord cut, which makes sense, right? But one of the things that's interesting with this company is that they're cutting costs while still generating a decent amount of cash flow, and the capex is declining, while their debt's declining, so the balance sheet is improving, and they can still make their dividend yield. So for reference right here, you can see that I'm still in this one. I haven't done a video on it yet. I'll probably do one in a bit, more of a deep dive instead of a brush over. But you can see the dividend yield still 7.7%. So it's a very interesting company, and it's trying to shift itself. So you can see revenue actually down year over year, which is never a good sign, right? That's what we knew going into this one. But they're also cutting a lot of COGS out, cutting a lot of SGA out, material amount, right? 11%. So while revenue's declining, they're cutting costs to keep it steady. Their debt's improving, so interest expense is going down. Also, interest rates are lower than they were at that time. That was right before COVID. But yeah, you can see that the company is actually doing better than it was pre-COVID, though the share price is still cheaper, which is what I want to see, right? But what I'm excited about, this is the bull case, so it's not really a balanced view for this purposes of this today. But you can see fiber and low latency. Really, it's like a data play, 5G, fiber requirement, your AR, like your buzzwords, the ARC buzzwords, right? Your AR, VR, all big data, robotics, Internet of Things. Basically, they're trying to just make themselves part of edge computing in the cloud, right? And use their fiber network for data. And you can see that right here. And they own quite a lot of fiber. But yeah, obviously this investment has risk because its legacy business is still declining. Voice is still in decline. Like, I don't have a landline phone, right? EBITDA, like I said, looks good. You can see the margin actually improving because they're kind of pulling cost out of the business, mainly from the legacy side, and they're allocating capital more to the fiber side. And that's what you'd want to see in a business and management. The reason why I saw this one is because actually when Scion posted their December 2020 holdings, you can see that Lumen was up there, aka CenturyLink. You can see it wasn't a small position for him, but I mean, Scion is a smaller fund, but I always like ones that he's in because he has some interesting ideas. So this was an interesting one that I decided to pull the trigger on, and their outlook is fine. Nothing too special here on this page anyway, but you can see free cash flow is still good. So no, the parts of the industry are in secular decline, but parts of the industry are not. And I find that Wall Street has a hard time dealing with that nuance. So they'll either focus on the declining business and won't be able to see the opportunity on the other side. And they do that with a lot of companies. So at least that's what I've been finding lately. So Lumen still, like this company, as you can see, has been getting destroyed over time, right? But I figured right around here, I decided to buy in. And you still get the dividend yield as they slowly turn around the business and allocate capital to where it needs to go. CooTek, so this is one been the plague of my existence. So this one caught a knife here for sure. You remember that was the mobile advertising China play. That's a really small cap. It trades at a discount to its revenue. For example, they did more than $400 million in 2020 in revenue, but the company trades at less than $200 million in market cap. So very interesting company. You can see I'm down 42% on this one. My average is 372. I'm probably going to add in, but I'm waiting for a reason. So I bugged this guy in the end of March after their annual results, only because they guided to $80 million in Q1, which is a lot worse than their Q1 last year. And I also want to see what they're doing with their sales and marketing expenses. So this is from the CFO. He's new. Anyway, he expects a reduction 10 to 15% in terms of S&M expenses. And this was interesting to me. As mentioned during the call, this is all mentioned during the call, just reiterating, and I was asking for clarification, but we still forecast year-over-year growth in our revenue for 2021. And that's weird because Q1 was horrible, right? Like their Q1 guidance was only 80 million and they did like 105 million last year. And this company has been growing like crazy, which I'll show in a second. So it's like, okay, what's happening, right? Market pulled back because, well, you're not growing, right? You're shrinking, even though and this guy's still saying he's going to grow by the end of this year. So they got 9 more months to show me that. I don't know. I'll see what happens on this quarter if I'm still going to hold this or not. And if I add to it, right? Because I want to add into this if this is true, if they're still going to be able to increase their revenue year over year while decreasing their S&M by 10 to 15%. Because that was the biggest con, was their S&M was actually accelerating just as much as the revenue was. Right? For every dollar they're getting revenue, they were spending in S&M. When I go to here, you can see what I mean. So Q1 2020, they did 107 million, but in Q1 2021, they're only getting 80 million, right? Which is back down to here. So that's why it started coming back. And we'll see if he's right, if he actually thinks that he can do more revenue than this year after starting with such a low guidance in 2021 Q1. So it'll be very interesting. I'm going to pay attention on that call for sure to decide whether I want to add or get out, but the decision's going to be made there. And then this is the biggest con with the company, was that while the revenue was going up like crazy, they're spending everything, like I said, in S&M. So S&M is this deep blue one, and you can see 100% of the revenue is spent. And that's on top of all the other smaller expenses like R&D and G&A. They weren't making money yet, even though the revenue's going up. But we knew that because it's growth phase. But yeah, this is a slide that really irked me. Right? You're like just blowing out numbers and revenue, then all of a sudden, boom, big 20% decline year over year in revenue. So we'll see if he's just talking up or what. But I caught a knife here, right around here. Yeah, right around my average, just under 4. So and I started printing number 2. So I might add going into it, but we'll see. I'd rather have more information before I make a decision on that one. ATCO, I mean, as we thought, earnings are still up year over year, mainly because, like we said, the structures and reopening. We figured that was going to happen. I still think this is going to continue. I didn't really talk about the ports, but I did talk about the utility. So ATCO, it's kind of that you have the Canadian utility play, then you have this structures and logistics kicker for growth. So you have the steady cash flow of this one, and then you have the rebound in this one. And that's kind of what we're seeing. I am surprised the price is still where it is. I think when I did the video, it was just under 40, but yeah, it's only at 42. And this company's putting up numbers that are back in line with 2019, but obviously still trading at a discount to 2019. So I'm still in it. I like this company from a utility play. It's a safer one, obviously. Only thing I saw and read on the expenses were that they started to creep up a bit. A part of that is that they're not going to be raising prices in Alberta in 2021 due to COVID. So the utility side isn't going to slowly increase with inflation. So I think that's going to be a trend for the next couple of quarters, but we'll see. Maybe ATCO's structures and logistics business can outpace that. But so maybe that's why it's trading at a discount to 2019 levels, but it's still at a very steep discount. I haven't done a gold company yet. I'm planning to do one eventually. I still own 3. Argonaut Gold's a bit interesting. So you can see that their cash flow is up about 2x, and you might think, okay, that's great, right? However, right here, you can see their expenditures on mineral properties, so their capex has went up 3x. So Argonaut's in a big growth phase, and one of the reasons why I got into it wasn't because I'm big bullish on Argonaut or not. It was just that this company got destroyed during COVID and right after COVID. Even though gold was going to, well, it actually sold off in a panic for a bit, for like a week. But after that, it just started ramping up, right? And we saw it pass 1800, 1900, 2000, I think into 21 or something. But anyway, I bought this company during that panic. So that's why the gain looks higher, right? 157. I'm not even on this 52 weeks. So I bought it more than a year ago. So what I have to decide now is if I want to stick around for this capex or not to come to fruition, right? And also what my overall outlook for gold prices are. So I still have to make that decision, but that's what I'm on the fence about. Argonaut has a very high cost, so high ASIC, I mean. At the same time, because gold prices are higher than they ever have been, they're still making a lot more money than they ever have. But they're putting a lot more into their business. And you can see their mines right here. Their ASIC is 1.3K. Higher cost mines, you can see this one, the Florida Canyon one's 1,400. But they do have some ones under 1,000. But overall, you can see the effect here. And the capital, where's it going? So you can see of that 38 million, because remember, a quarter 2020 Q1, they're only spending about 12 million. Now they're spending 38 million. And you can see 26 of that. So the entire delta is really from Magino, which they financed with share issuance. So basically, they diluted my investment to invest capital into Magino. And this mine is pretty good. The question I've asked myself is, do I want to wait around full production in Q3 2023? See? So that's a decision I have to make. And it also will depend, like, where do I think gold is in between this time, right? Because if gold ever starts coming back down to 1,400 an ounce, right, this company is barely making money because it has such a high cost. Though this mine's going to be, once it's up and running, it's going to be a gem for this company. But I just had to ask myself, do I want to come in now? Do I want to leave and come back once I see if there's any problems with the execution risk, or if they push this out, right? Or where gold price is going into, and there's a lot to think about with gold and this company specifically because it's a higher cost one. But yeah, you can see the panic here. That's where I picked it up. I actually think I waited a bit for the uptick just to make sure. But yeah, I'm still in that one. And then Enbridge. So Enbridge, very interesting. They reported Friday, so yesterday. You can see right here, like we thought, well, I mentioned another thing, it's kind of like a quasi-utility, not true utility, because it's pipelines. But they have a pipeline, then they have utility play, then they have a distribution play. So I'm still in it, still pays almost 7% dividend. I used to pay over that, but the price has appreciated. You can see, yeah, like I said, EBITDA is fine, cash flow is fine. CapEx is increasing, so I was like, okay, CapEx is increasing, and that's also in line with what they were saying when I bought the company. You can see right here that their outlook is actually ahead of 2021 numbers. However, the share price is still not back to 2020 numbers, so there's still a discount here. I'm still in it, or at least I view it as a discount. One of the things that's very exciting to me is when they get this line 3 upgrader done. You can see the sensitivity on cash flow. Like this one is just more volume, what it means for them. So say if Suncor is producing more and transporting it on Enbridge's lines, Enbridge obviously makes more money, right? The more production that's done by these oil and gas companies. So that's, you can see the sensitivity, there's only 12 million. This one, and this is just if they finish the line 3 upgrade on time, like every month that they're either early or late, costs them 75 million bucks in cash flow, not just revenue. So this is exciting upside for 2021. Even if they don't finish this, they're expecting this to finish in Q4 2021. 2022 will look really good. Line 3 replacement. So this is just what I was talking about. And it's on track, targeted for Q4 in service. And they've already been spending CapEx on this. And like, again, we just saw in the Q1 numbers that there's higher CapEx. This is where it's going. And it's going to be a free cash flow addition to this company as soon as it's done. Biggest risk, and probably the reason why it's still lagged a bit, is the Line 5 and all the drama associated with Michigan. But I view this like, I think as it's critical to this whole area, right? It's not just critical to Michigan, it's critical to Ontario, it's critical to Quebec. I mean, it's 500,000 barrels a day, and I don't think you can just get an alternative like that overnight. So if Michigan wants to stick to their ideals, sure, but I think they're too early in that, and I think the tunnel makes sense. Because obviously what's happening, like I said on the video, is that the ship anchors are hitting this as they go across the Great Lakes. And it's slowly denting this pipe, and Enbridge is like, well, I'm just going to build a tunnel for this, right? And for some reason, it was hell to try to get this permitted. even though they're trying to mitigate the risk that the Michigan government is trying to address. Obviously, they just have differing solutions where Michigan doesn't have one and Enbridge does. Anyway, I still view upside in Enbridge and pay a nice dividend while I wait for that. Last one, ARC. So I started, in the last video, I kind of talked about ARC and what I'm thinking. And as innovation is starting to fall out of favor, that's when I start getting excited, right? And a lot of these things, you can't really look at the 52-week high because that was like an inflated hype price. But what I'm trying to do, and it's hard to value these things, right, is I'm trying to pick up some of this growth because I didn't have that much growth, right? I mean, I have some through cannabis, but not through more tech plays and software plays and stuff like that, especially China Tech I'm still looking at. So I bought Pinduoduo. This company, you wouldn't buy it for its current revenue or earnings. It's really just a high grower, and the app looks very interesting, like the whole collaborative shopping and the Costco feel. It's very interesting. CRISPR, still in this one. This one's interesting. I'm digging deeper into this one as I go with the patents versus Intellia and Editas. I'm gonna probably do a video on that in a bit at some point, just to see where it lands. And then Invitae as well. I bought that one. Genomics. I think that's gonna be a big one. Like their tests are sell them for $300. I think a lot of people would pay $300 to see what type of cancers or what heart disease, right, and your predispositions and all that. Get your genome mapped. I think that's smart because that will save you a lot of money in healthcare costs down the road, either on the individual level or the industry level. And well, the thing is, I don't know if Invitae is going to be the one to take the cake on that or not, right? But right now they're growing quite a bit, so we'll see. And I'm not getting it is down quite a bit, but again, you can't just view that because this could be a fake high, right? Just a speculative high. Anyway, over time, whichever company, like if Invitae is the genomic sequencer champion, then yeah, this thing's gonna be worth a lot more than that. But the thing is, you have which one's gonna win, right? CRISPR it is the technology, right? But does that mean CRISPR Technologies wins, right? Or are other companies deviate from that enough, and then CRISPR is really just a patent play, and then we're not even sure what the patent's going to look like in the States, though it looks like internationally CRISPR looks like the favorite. So anyway, I'm kind of rambling a bit there on the innovation front, but I'm looking at that. I'm also looking at Baidu and Unity. There's a lot going on my plate this week. I figured I'd do a little quick update, try to tell you where my head's at with certain positions and what I'm doing. So yeah, really all I did this week was add to Invitae from a trading perspective, and just listened to about 14 conference calls. But yeah, anyway, have a great rest of your week.